we're excited to talk about some year-end tax planning here, and talk about not only how it impacts your business owner, how it impacts your personal financial planning, but also the potential impacts of the election and what that might mean for policy as well. And so, as we get started here today, couple of introductions to do. I'm John Owens. I'm the managing partner here at Brooklyn FI. Excited to be hosting this webinar alongside my two esteemed colleagues, Caitlin Fastiggi, who's our Director of Financial Planning. Caitlin, so glad to have you here, and Tiffany Parker, one of our amazing tax managers on the team as well. As we alluded to, Caitlin's in New Jersey, Tiffany's in Virginia, I'm here in Pennsylvania. So we got the East Coast, the Mid-Atlantic pretty well covered here today. And we're excited to roll up our sleeves and dive into some planning here. So a couple of housekeeping items before we get started. There is a Q&A for this that you can drop in questions. And so if you want to drop in a question in the Q&A, you can go ahead and do that. That's how we would love for you to submit questions for this. And so if things come up along the way, we'll try to answer them as we go, or we do have some time at the end saved for Q&A. We'll do our best to answer them live, of course. And then within a couple of days, we're going to take this webinar recording. We are going to post it online, brooklynfi.com/events. We'll have it up on YouTube. And so if you have to duck out a little bit early, if you miss something, if you want to come back and say, what the heck was John talking about? We'll have that recording available to you within the next couple of days. We'll follow up with a copy of that recording. Now, stick around to the end because one lucky attendee is going to leave here with an Amazon gift card. And so we'll be picking that person at random here a little later on in the webinar towards the end when we get to that Q&A session. Must be present here to win. And so without any further ado, let's take a look at today's agenda. We're going to talk about year-end tax planning for business owners, primarily small business owners. We have a lot of clients who are entrepreneurs, creative folks who have small businesses. Tiffany's going to walk us through some of the planning considerations for folks who are business owners. We're going to talk about some personal year-end tax planning to think about, both with retirement account contributions, with other strategies. And so Caitlin and Tiffany will be talking a little bit about that. And then I'm going to talk a little bit at the end about the potential tax changes, the Trump policy proposals, and what could be happening in a new Congress, a new president here in 2025, and what that means for you. There's still a lot of things we don't know, but we will. We're going to try to navigate and make sense of what we know so far and what some of the proposals are. And so glad to have you all here. And Tiffany, happy to turn it over to you and talk a little bit about tax planning for our business owner folks here who are on the call.
Hi everyone, I'm Tiffany. And so we're going to kick it off by starting about talking about deferring revenue and accelerating expenses, which both are very common practices for small businesses owner to do. So if it's possible for a tax purpose, it's more efficient to defer revenue into the next year. Tax years are on a calendar year basis. So if you can recognize income in January rather than December, that allows you to defer that income out. And that can be potentially beneficial, especially if you're expecting the income tax rate to be higher in the following year or lower. You can defer that income out to there. And so what you can do if you have an invoice to a client, you can just say, hey, hold off on paying this out into January, and that allows you to push that income out. Just something to be mindful of if you are a cash-based businesses. Constructive receipt is something that you can utilize, and that's when you have access to the funds before you actually receive them or they're deposited into your business bank account.
And so constructive receipt, Tiffany, just to clarify for some folks, that means if like somebody gives you a check on December 1st and you don't cash it until January 2nd, you're still supposed to recognize that revenue in December because you had it, you were sitting on it. That's not a way to defer revenue, but you can defer revenue through maybe waiting on sending an invoice to a client until it's not due for 30 days and you send it on December 31st when they're closed for the holidays. That is a means of deferring that revenue, perhaps.
Exactly.
We also have accelerating expenses. What does that look like?
So accelerating expenses, like the more expenses that you have to offset your income, that causes your net income to be lower, which means you'll result in paying lower taxes. So you can do that by prepaying your expenses. If you have some expenses that you know that are due earlier in the year, like early January, you can pay those expenses now so that you're able to take that tax deduction in the current year.
And this works out really well for folks. Maybe you use a business credit card. You're trying to get the points. We love our Amex points here. Our podcast this week will be talking about that. So you might have a situation where, hey, I really want this expense. I need the write-off this year. I may not have the cash to pay for it right away. And so I'm going to run it through my credit card. At the end of December, I can write it off then. And then I'm actually going to pay off that credit card in January, maybe when I invoice that big client or that project that you're waiting on. And so some things for folks to consider there as well. And then we've got a lot of folks who are remote, Tiffany, who have home offices, their business and personal finances gotten intertwined. What should they be thinking about?
Yes, if you have a home office, you may be able to deduct a portion of the mortgage interest and real estate taxes if you own your home, and if you're a renter, a portion of your rent as well as your utilities, and any office-related expenses. Like if you bought a new desk or a new work chair, or you redecorated that office, you can allocate a portion of those expenses as business expense to help offset your business income, as well as your cell phone. If you use your cell phone for 50% business, or your internet services, and of course, any business related travel, like you travel to go meet a client to discuss a proposal or a plan, all of that can be deductible as a business write-off. So just keep that in mind.
Absolutely. Keeping good records, trying to make sure you keep your business expenses on the business, but when they veer into your personal life, keeping track of those because there might be a nice tax write-off here. And so that is great. Thank you, Tiffany. Caitlin, for our small business owner folks, self-employed folks here on this call, they might be looking at their tax projections now, seeing some numbers this year. They might have made a lot of money. Sounds like there might be some ways for them to do something about that.
Yeah, there are 401ks and retirement plans, especially for our self-employed people. And it's kind of like we get to pay ourselves before we pay the IRS. So we reduce our income while paying ourselves. So here at Brooklyn FI, our goal for every client is at least a 20% savings rate. So we want not grow, we want the net income savings rate to be 20%. This number helps accelerate our retirement wealth growth and allows us to have that early retirement that a lot of people are aiming for. And maximizing those contributions is key to this strategy.
Yeah, and so when we look at somebody who's self-employed, doesn't have any employees, just a sole proprietorship, how much can they end up writing off here?
Yeah, so as a sole proprietor, we can write off 23,000 of our self-employment income, and then 20% additional of our self-employment income up to $46,000. So that's $69,000 potentially being able to be contributed to this account.
And somebody with $100,000 in income this year, for example, could put up to about $41,000 into a solo 401k because they're both the employer and the employee. That's 40 plus percent.
And now that money is growing tax-free long term. And yes, we'll pay some taxes on it when we pull it out in retirement, but there's a lot of strategies around that later on.
Absolutely. Absolutely. And so it works a little bit differently for folks with S Corps in terms of how that might flow.
Yeah. So with an S Corp, you're taking a wage. So we can take up to 100% of our gross wages up to that $23,000 number. And then 25% of the gross wages up to that $46,000. So it's still the same $69,000, but there's a little different threshold. So if we have that $100,000 of wages for the owner, they can make a total 401k contribution this year of $48,000.
Yeah, that's a little bit higher than somebody who's self-employed and doesn't have an S Corp. So one of the advantages there. And then partnership folks, slightly different as well. They're more similar to the self-employed individuals.
It's more similar to the self-employed individuals. So that self-employment income, we can go up to the $23,000, just like the sole proprietor. And then it's 20% of the self-employment income up to the $46,000 limit. So if we have that $100,000 of partnership income, we are looking at a total 401k contribution of $41,587 this year.
Yeah, Nice potential write-up. And there's still time to open up a solo 401k if you are self-employed, if you have one of these business entities, and get it funded before the end of the year. That employee contribution, we typically want to get in during the calendar year. The employer portion, in certain situations like partnership, self-employed, or sole proprietor folks, that actually gets determined when we file your taxes. So we have to typically get that done by April 15th, March 15th, September, October 15th, depending on when your returns actually due, and that can account for tax extension. So we have some more time to maybe come up with the cash for some of these things. Now, we did get one question in the chat, which is, if I already have an employer 401k, what's the advantage of also having a personal 401k or solo 401k? And really, the solo 401k is for folks who are self-employed and have self-employed income. And are not working a W-2 job. Now, some folks may have both. They may have a W-2 job and then do consulting work on the side. What's tricky and we need to keep in mind is that $23,000 contribution that you're making, you can't double up. You can't do it twice. But you might be able to still do the employer match if you are self-employed. For a lot of folks, they're typically doing one or the other, or transitioning from one to the other. And then we just look at what makes sense to consolidate. What's the most efficient option there? What's the most cost-effective way to handle it? So great question. Moving along here, tax planning opportunities for individuals and families. Tiffany and Caitlin would love to kind of hear about what are some of the things we need to be thinking about between now and year end.
We need to make our retirement contributions. That's the most important thing. So make our IRA contributions now. This year, the maximum is $7,000. Technically, the IRS allows us until April 15th, but it's cleaner if we can get it in the calendar year. And if we are age 50 and older, we get a little bit of a additional contribution of $1,000, so we can make a total $8,000 contribution.
Yeah, nice little catch-up contribution is those the one benefit of inflation over the last couple of years is that these contribution limits have gone up a bit annually when we adjust them. Tiffany, what about 401k?
Yeah, so for a 401k, the maximum contribution you can make this year is $23,000, and if you are 50 years and plus, you can make an additional $7,500. And these contributions must be made through your paycheck and have to be completed by the end of the year.
Absolutely. So that's the tricky thing. If you haven't been contributing, you might need to adjust those paychecks really quickly. Log in on this call if you want to try to hit it. You might
right after this
bump
call,
that percentage up real quick if you haven't done it.
Yeah, one way, like if you know you have a bonus coming before the end of the year, one way to get that taken care of, you can make it so that all of that gets contributed to 401k. So that's something to keep in mind.
Awesome. Caitlin, how about 529s?
Yeah, 529s. Again, these are something that we need to make a contribution in the current calendar year to be able to take a benefit. The 529s are education savings accounts. So do we have kids? Do we have ourselves that may want to go to college in the future? Do we maybe want to have kids in the future? All of this we can put up to $5,000. Well, we can get a New York state tax deduction for $5,000 if you're single, $10,000 if you're married for making these contributions. If we live in a different state, we have different contribution levels per state. I live in New Jersey. It is a $10,000 deduction in New Jersey as well, but your income must be under $200,000. So it is state specific.
Yeah, some states like California don't offer any deduction at all for the 529, whereas other states allow you to deduct tens of thousands of dollars. And so, as Caitlin said, very state specific. It's something we think about before year end. Tiffany, what about charities? Is there still time to give to charity this year?
Yes, if you're already itemizing your deductions, you can make charitable contributions, whether you donate cash, appreciated stock, or clothes or household furniture. You can make those donations now before the end of the year. And that will help to reduce your income. And if you have a donor advised fund, any contribution that you make to your donor advised fund will be treated as a charitable contribution on your personal income tax. So that's something to keep in mind if you haven't made that contribution yet and you're wanting to and already itemizing, that could help to boost your itemized deductions even higher.
Yeah, and Tiffany, just to kind of highlight donor advised funds and how they work, right? You're if you're sitting here, it's the end of the year, you're like, I want to be very deliberate about my charitable gifting. I haven't vetted the charities yet. I'm not sure exactly where I want it to go, but I have a big income year. that's a good tool, right? You can tap into that.
Yes. And that's what's great about a donor advised fund. So you want to get the deduction this year, but you're not quite sure what charities you wanted to pay out for. You make the contribution to the donor advised fund, and then once it's contributed, you can later work with that fund to determine which charities will receive it, but you've already taken that deduction in a tax year when you need to take it.
Absolutely. Really nice setup to get the tax benefit now and then give to charities over time, of course. And so before we get into the deadlines here for certain tax items, there have been a couple of questions that are dropped in the chat. I'll take this one. One is, how should I approach tax loss harvesting before the end of the year? Great question, right? Tax loss harvesting is a nice planning opportunity for folks who have taxable investment portfolios, so brokerage accounts where the money is taxed as you have dividends, capital gains, interest, that sort of thing. Tax loss harvest, we want to take a look around. We want to see, are there positions at a loss that we can shed and take a loss to offset maybe other gains that we have from concentrated stock positions or rebalancing that happened in the portfolio earlier in the year. The one thing I'm noticing a lot of, the market, as we go back to like last Halloween through now, so the last about 13 months, the market has gone up and has gone up quite a bit. And so we're always hunting for tax losses to harvest for clients. We're coming back empty-handed these days, and that's a good problem to have because the markets by and large have done quite well. And so go and take a look. Definitely something we look for every single day for our clients in the portfolio, especially when there's volatility. But there's just been a little bit less of that. And there's another question, Caitlin, maybe you could take this one. Are there specific retirement accounts that offer more favorable tax treatment that I should consider?
Yeah, we also have our Roth IRAs. With a Roth IRA, we're putting money that we've already paid tax on. It's going to grow tax-free, and then it's tax-free in retirement. There are also Roth 401ks that we can contribute to. The decision on when to contribute to a Roth 401k or Roth IRA is greatly based on our income. One, the Roth IRA is limited to how much we can contribute based on our income, if we can contribute at all. There is a fun little backdoor Roth IRA that is eligible in the right situations. And then with the Roth 401k, it really depends on where your income is. Is the benefit right now greater to you, getting that immediate tax deduction from the regular 401k? Or are we in a lower tax bracket this year where we want to contribute to a Roth IRA and get that future tax-free growth and that ability to take that money out in the future tax-free, where with our traditional 401k, we're going to have to pay tax on that when we take it out later on.
Yeah, absolutely. So a lot of considerations when we're funding these accounts at year end that require having some clarity about what your tax situation looks like now, maybe what it's going to look like in the future, those sorts of things. And so we've got a handful of deadlines here to think about. 401k contributions, the employee piece at least needs to be in by December 31st. IRA contributions not technically due until April 15th, although we like getting done in the calendar year, just a little bit cleaner planning wise. Fourth quarter estimated taxes are due January 15th, and so you have a little bit of time to pay those. For those of you who are Brooklyn FI clients or thinking about coming on board with Brooklyn FI, we need to sign an engagement letter on file by January 31st to file your taxes. February 15th is our deadline to get all your tax documents in so we can ensure you're filed on time by April 15th. And any taxes for 2024 that you still owe and your first 2025 quarterly estimated payment is due on April 15th as well. So some fun deadlines. Take a second, screenshot this if you're wondering, trying to keep track of that sort of thing. And so moving on, we had a presidential election a few weeks ago. We now have Trump coming back in office as the president-elect. We will have a Republican Senate, and we're going to have a narrow Republican majority in the House. And so complete control by one party. And that means we're probably going to see some changes to the tax code. And so thinking about what are some of these changes. We've heard a lot of rhetoric throughout the campaign. We've heard policy proposals. We also have policy proposals that we heard about during the last Trump administration that maybe didn't get implemented. And so we want to take some time talking about what are some of the major changes that could be on the horizon. And so a few things that came to mind, making the 2017 tax cuts permanent. So the first round of Trump tax cuts, they were passed under a budgeting concept and a Senate concept called the reconciliation process. And what that means is they needed to be temporary. And so they need to expire at some point, and they expire at the end of next year. December 31st, 25 is when most of the provisions of the 2017 tax cuts expire. And so one proposal is to make those changes permanent, or at least extend them. We also have another proposal to exempt tipped wages and overtime from taxation. That was one of the campaign promises that was thrown around out there. And so carve outs for certain tipped workers in certain industries, or certain workers who work overtime, to exempt those excess earnings from taxation. There's some talk about eliminating taxes on Social Security benefits. It was the 1980s when we started taxing Social Security. It used to not be taxable. They're talking about making this untaxable again. Another relic from the 1980s and before that we're talking about bringing back is writing off auto loan interest. You can write off your home mortgage interest, that sort of thing. You used to be able to write off all sorts of interest on your tax return back in the day. There were a lot more deductions 40 plus years ago. There's talk about bringing that back, being able to write off your car loan. And then the biggest kind of unknown factor that's floating around out there is a proposal to impose tariffs on a variety of imported goods from foreign countries, and how that might impact the tax code, how that might impact your bottom line. Little more difficult to quantify, right? There's different tariff percentages being thrown around. There are countries where we have free trade agreements with them that prohibit these sorts of tariffs. And so it's probably the biggest unknown, but probably a big factor in this making the 2017 tax cuts permanent, because that is revenue that Congress will likely use to count on to offset the taxes lost by letting these not expire. And so just kind of getting into the details of a few of these proposals here. And so making the Tax Cuts and Jobs Act permanent will be a really expensive thing to do because that is revenue that has only been temporarily accounted for in the federal budget and the deficit forecast. And so if Congress does nothing, which I think if there's anything we can all agree on, that they are very good at doing nothing. These will expire and at the end of next year, and there will be more tax revenue coming in because we will revert back to the tax code before the tax cuts. To make them permanent, there will be a significant revenue loss that is currently in the budgeting forecast. And so what will likely happen is we'll either see the deficit go up and the debt go up, or significant cuts to government spending, right? One of those two things. And so those things are both very unpopular. And so what normally happens is we kick the can down the road. The other thing that's really tricky is to make these permanent requires passing the Senate and breaking a filibuster, which requires 60 votes. There's going to be a 53-49 Republican, 47 Republican majority in the Senate, it looks like. That's not 60 votes. And it'll be very surprising to see 7 Democrats come over and support the extension of these and the permanent of these, making permanent these tax cuts. And so we'll likely see this extended for a period of years instead of permanently. And so that is one way for them to use this budget reconciliation process to get that done. Now, overtime and tips. There's proposed to eliminate taxes on this, but there's also a lot of questions about what this means, right? If that means maybe if overtime isn't taxed, are you still going to get paid time and a half for overtime hours? That's one question. Will employers be able to deduct the wages they pay for overtime if it's not taxed? Okay, when your employer pays you, that is a write-off for them. It reduces their tax bill, and you pay tax on those wages. If you're not going to be taxed on overtime wages, then will your employer still be able to deduct them? That's another question. Are we talking about federal taxes? Are we talking about Social Security and Medicare as well? And so those have big impacts on those programs. And also, whose overtime? Whose tips? If we're really going to eliminate taxes on overtime and tips, then I would like to only be compensated for overtime hours and in the form of tips, right? That's a great deal. I will take that. And so they'll have to be very specific when they're carving this out so it doesn't get exploited like many other loopholes in the tax code. Social Security taxation, Tiffany, we've been taxing 85% of Social Security income since the 90s for most taxpayers. I'm going to guess there's probably a lot of revenue tied to this, Tiffany, right? This is a huge amount of people's income. It's, we've all done a lot of tax returns over the years with some Social Security income on them. And a lot of people who have a decent amount of other income are in higher tax brackets are paying tax on this full 85%. And that's a big driver of federal revenue. And it's helped stabilize Social Security over time. Other details, writing off auto loan interest used to be deductible back in the 80s. Brings back an itemized deduction. Most folks here's the thing. Most people don't itemize their deductions these days. I'd be curious, Tiffany. I think we saw itemized deductions get cut in half probably after Tax Cuts and Jobs Act came out.
Yeah, because the standard deduction was so high, unless you had mortgage interest that was pretty substantial, that a lot of people were phased out of itemizing.
And you know, a lot of folks in those early years of the Trump tax cuts, mortgage rates were still very low in the 3-4% range, and so it was actually hard to be over the standard deduction for married couples of, you know, 28, 29,000. Next year, I think it's $30,000 standard deduction. That's a lot of mortgage interest when your state and local taxes are capped at 10 grand. And so writing off auto loan interest is interesting, pun intended. Might come back into play, but a lot of folks are still taking the standard deduction, and so it depends on who might this really impact. It's actually a smaller subset of folks, but that could change if we repeal the SALT cap, which is the limit on state and local tax deductions, which is currently capped at $10,000, has been capped on that since the original Trump tax cuts, which limited them. The tariffs, again, biggest unknown here, potential 20% tariff on all imported goods, potential 60% tariff on all goods with China, could synthetically function as a sales tax. Somebody needs to pay that tariff. Businesses are pretty good at passing that cost on to the end consumer. And so there's a lot of talk. Is this negotiation for better trade deals, better trade policies? Less likely maybe something that becomes a reality, but it could synthetically function like a national sales tax that you're starting to pay on things that you consume, in particular goods that are imported from abroad. And so there's a bunch of other proposals that have been floating around from either from campaign rhetoric, from the prior administration, that sort of thing. So talking about expanding the child tax credit, we'll keep an eye on this. Various dollar amounts. We saw both candidates talking about this, talking about appealing some of the Inflation Reduction Act tax credits for green energy. There's talk about repealing Obamacare. Obamacare was in part a tax bill. There were some taxes that were levied to fund the Affordable Care Act. So a 3.8% net investment income tax, 0.9% additional Medicare tax. Some interesting thing for investors, potentially increasing the amount you can write off as a capital loss, indexing the cost basis of our investments to grow with inflation. Potentially, Caitlin, some more QSBS and bumping that up from 10 million. That'd be a pretty nice deal.
That would be a nice deal for folks that were early investors in company and have held the stock for at least 5 years.
Hold the stock for at least 5 years and already have $10 million in appreciation that they're trying to exclude. So
Exactly.
there's talk about eliminating the estate tax, another piece that we've heard over time as well. And so what are the potential consequences of these proposals, right? We're talking about proposals that may or may not become law. If we have any familiarity, what were we talking about here 4 years ago? 4 years ago, we were talking about free community college. We were talking about this much higher estate tax, much higher income tax than folks that make over $400,000 a year. None of that really happened, right? And so it's important to remember that a lot of proposals kind of go through the sausage making that is the legislative process and get spit on the other side, either in a watered down form or don't happen at all. And so we're taking a leap here, but let's just talk through how some things could be affected if this were to happen. And so one thing is the return of AMT, or the alternative minimum tax. And so we deal a lot with AMT here at BrooklynFi because many of our clients have stock options where they pay alternative minimum tax. Looking here, though, most people don't pay AMT, and that's a change, right? A lot of people used to pay the alternative minimum tax because there used to be a lot more write-offs. And briefly, the alternative minimum tax was like a parallel tax system that calculated your tax differently and added back these write-offs. A lot of the write-offs went away with each tax code iteration, and so therefore a lot of people don't pay AMT. But if we bring back write-offs like a higher state and local tax deduction, or writing off auto loan interest, that sort of thing, and the AMT exemption comes down, then this could be something. A lot of uncertainty, right? Another thing we need to think about. There's a lot of talk of first 100 days, what's going to happen in Congress, an ambitious agenda. Fundamentally, though, it takes a long time for a tax bill to come together, for a budget reconciliation bill to come together. When the 2017 tax cuts were expired, passed. It was right before the holidays. And so it could be very late next year till we know, is this going to be extended? what's that going to look like? And so we're going to be looking planning wise for what is the low hanging fruit for planning, knowing that we're not exactly sure what that outcome is going to be. And then tariffs. We don't know what the consequences will look for that. There could be an impact on consumers, impact on inflation. They also could be using that revenue to offset other tax cuts or extensions, right? So Congress always gets interesting with their math and their calculations of how they value this new revenue source to pay for a potential tax cut. And so are there planning opportunities that you need to think about with the potential of the tax cuts being extended now with the proposals that we're hearing? There are a few. First of all, we've beat the drum to death about this, but continue to max out your retirement accounts and optimize those if you can, if you have the flexibility to, if it works with your financial plan, because tax rates are likely not going any lower for folks. They might be going up for some folks. They might be staying exactly the same, but they're likely not going lower. If you have estimated tax payments, Caitlin, we have a lot of clients that have estimated tax payments here. We're telling them to pay them January 15th, right? That's what they're due.
They're due January 15th. If the SALT cap comes up next year, there may be a benefit there where if we're making our state estimated payment in 2025, maybe we get to take a little bit more of a deduction if the SALT cap increases.
Yeah, that'd be a nice deal. And so no real incentive to pay your state and local taxes sooner than 2025 at this point. So make them in January. And then most of the potential movement in rates is tied to ordinary income brackets and not to capital gains rates. And so we're likely not going to see major shifts in capital gains brackets, perhaps. So there's some planning to do. The 15% capital gains bracket is a great rate. 0% is even better. If we're not maximizing that already, we should be thinking about it. And then with federal taxes likely to stay similar, that's the current assumption. When you think about geography in your planning, are you moving out of the city? Are you moving to a lower tax state? That is actually probably much more impactful on your tax bottom line than what the folks in Congress are talking about today. And so those are some things we need to think about here planning wise as we get late here in 2024. And so there are a couple things to just take away from all this before we jump into the Q&A segment, which is tax. There's still time to do tax planning before year end. There's still time to make contributions to retirement accounts, to, if you're a small business owner, accelerate expenses, defer income and revenue. There's a big question mark as to what President Trump will do, what congressional Republicans will do, what actually makes it through the various houses. And you have to remember, a very tight majority in the House of Representatives means that every vote counts. And so there will be folks leveraging that influence, much like we saw a few years ago in the United States Senate when it was a 50-50 tie in the Senate and everybody kind of held that trump card, so to speak, pun not intended again, there. And then ultimately, personal tax planning is personal. It is driven by your goals, your income, your assets, your specific situation. So we've given lots of, tax tips, tax advice here for planning for year end. But ultimately, the advice for your situation may vary. It might not be applicable, and you need to have a plan that's tied to your situation in order to make some determinations there. So we're happy to jump into some Q&A here, and there are a few questions in the chat before we jump to the ones in our slides. So I just want to take a quick look at those and see. Let's see here. Tiffany, we got a question about what documentation should I have in order before filing my taxes next year? Any tips on, some record keeping people need to start doing now to make tax season a little bit easier?
Yeah, so as far as related to charitable contributions, of course, keep a copy of your receipts that you receive. And a lot of times those organizations will send you a letter via email or through the mail. So you can just consolidate those, as well as for your businesses, any expenses that you're taking. If you use QuickBook Online, they have nice little apps that you can use to take a picture of your receipt and it sends it to your report. So just keep a copy of everything because you have to have support for any deductions that you're claiming. And then on the reverse for income, any income that you're receiving, make sure you have a copy of those invoices as well and just consolidate it all. And I always tell clients, if you're unsure of whether or not it'll affect your taxes, just send it to me anyway. Let me determine it. I would rather have too much information from you than not enough.
Absolutely, absolutely. And another question, Tiffany, that came in, the tax cuts, are they only going to expire for a certain level of income or for everybody? Right now, it's everybody, right? The
Yeah,
Trump
right
cuts
now it's
expire.
across the board. So all the tax rates are set to expire for everyone. So that will, if there's not extended, then they'll go back to what they were previously, meaning everyone's going to see an increase.
Another good business related question from Annie. I'm looking to start a business next year. Is it possible to start to collect expenses already this year as I am traveling to nail down the details? So we're talking about business startup expenses, it sounds like, that sort of thing. Tiffany, you want to just shed some light briefly on how we can expense potentially startup expenses for business?
Yeah, so you could just keep track of those, and even though you haven't legitimately like formed the business yet, when you file the tax return for the following year, you still can be able to deduct a portion of that. Some of it might have to be capitalized, but yeah, it's good to just keep track of that. So like all of your registration fees that you're paying, like formation fees associated with the attorney, all that could be taken in consideration and considered startup costs.
Got it. Yeah, great question though. Keep good records, and our team will help you find the best write-off opportunities there. Somebody's asking Caitlin about which strategies do you recommend for charitable gifting as we think about year-end tax planning? What are some of the strategies we should think about there?
Yeah, I mean, one benefit is if we're having a higher income year this year and we like to make charitable contributions every year, do we push 2 years of charitable contributions into 1 year to get a bigger benefit in that higher income year? Do we have appreciated stock, specifically long-term stock? So stock we've held for more than 1 year and 1 day. Has it appreciated a lot? Instead of selling that stock, maybe we give that stock to the charity or to a donor advised fund, and then we don't get the capital gain hit, and we get the full tax deduction for the current fair market value of that stock. So kind of a double benefit in there where we don't have to pay tax and we get to donate it to the charity at the full value. Making sure we keep receipts, as Tiffany said, as well for those physical items we donate. We want to be able to prove what they are valued at. And just because we paid X number of dollars for them 5 years ago, that may not be what the value is now. And we're only going to be able to take that tax deduction for the current value. And then looking at where we are on that itemized deductions, because charitable contributions are an itemized deduction. So are we already itemizing, or are we close to that line of itemizing, and kind of how much of a benefit are we going to actually get?
Yeah, great questions. Great answer there, Caitlin. Great questions here that we have rolling in. And so another question was asking about how can I effectively review my financial situation to identify potential tax saving opportunities? We really love a tax projection for doing that. That is the best way to understand how your taxes are going to be and how to plan for it is to know exactly what your tax return looks like right now. And so for our clients, we do a projection. We do a projection for folks this time of year. We look at how the numbers are right now, and then we model out scenarios. Well, what if we did this? What if we did that? How much is that going to save you in taxes? What does that look like? And kind of following up on that, can our team help with a long-term tax strategy that's aligned with your overall goals? Absolutely. That's what we do all the time for folks. And so tax planning in particular is not a how do I lower my tax bill as much as possible this year? It is really how do I optimize my tax bill over the course of my lifetime, which may in some years be accelerating income and having more income when you're in a lower tax bracket. And it may be some years deferring income and optimizing that when you're in a higher tax bracket. If you actually try to pay the lowest amount every single year, you may be leaving an opportunity on the table. And so that's something that we can help folks with all the time. And so want to jump before we do our drawing. I want to do a few more questions that were submitted ahead of this call, and so we'll come back to that in a second. Somebody had asked ahead of our call and submitted some questions around tax loss harvesting through direct indexing is a nightmare to unwind and needs fresh capital to accumulate loss. Is it worth it? Great question. I wonder who planted this. I didn't plant this. This is a rant that I go on from time to time. Direct indexing, we've seen those 1099s, Tiffany. They are like 200 pages long, aren't they? It's like,
yeah,
it's insane.
We don't love to see them as a tax preparer.
We don't love to see it. You love to see it. You don't love to see it. direct indexing is a tool that is valuable for some folks and can make a lot of sense for very specific situations, but oftentimes ends up with this basket of stocks that you need to maintain and drives down the cost basis of it. There are ways to do tax loss harvesting in a diversified portfolio with index funds without having to own tons and tons of stocks, without having to pay additional cost, because you own all those stocks. And so do I think it's worth it? I think it's worth it in certain situations, but I think it's been a little bit oversold to the masses. And so we take a more nuanced approach. We want to make sure that if we're doing direct indexing, it's really aligned with your goals, your unique tax situation, how your capital gains are going to look not only this year, but on an ongoing basis. And I also like it for folks that have some strong ESG preferences, socially responsible investing preferences, because direct indexing allows you to get more nuanced. But yeah, tax-wise, there is a benefit, but probably not the people who sell direct indexing would tell you it's a little bit more vast than I would take it to believe. The next question here about state politics relative to national politics. Caitlin, we're both the political junkies on the team here. I think Tiffany probably a little bit by extension. But Caitlin, what do you think about this one? The impact of state policies versus federal ones, and how people should be thinking about that in a fractured political environment we're in right now, and all the planning people are trying to do.
Yeah, I mean, state policies have a large impact on our day-to-day lives because we live them. I think the biggest impact for our taxes is going to be that state and local tax cap, especially for those folks that live in higher tax states. I don't see that part changing. For those states, they're going to continue to be higher tax states, and that's going to continue to impact people significantly if the state and local tax cap does not increase. But from an individual side, there may be a big impact around education. A lot of people who pay high property taxes, the majority of their property taxes is probably going to schools. And if something changes there in the future and the states are making changes, that may have a big impact on your bottom line.
Yeah, definitely. All politics is local, and definitely the more local it gets, the more direct impact it has. But recognize that national policies have a big impact on a lot of our clients too, depending on the life that they live in and some of the proposals that have been thrown out there. Tiffany, if somebody asked you what is the most urgent tax planning action that they should take between now and year end, is there one that comes to mind? Oh, I'm going to ask Caitlin too, so no pressure. We'll go around the horn here. But what do you think it might be?
I think probably the most urgent, because it definitely has to be done before year, and we've been saying it this entire call, is maxing out your 401k or making your IRA contributions. And also, if you're going to do the charitable planning, getting that done, because those all, the more you contribute to your 401k, that reduces your taxable income. So that's beneficial there, as well as charitable contributions increase itemized deductibles, also just decreases your taxable income.
Absolutely. Caitlin, what about you? What do you think for year end?
I definitely agree with the 401k. We only get the deduction, 23,000 this year. We get 23,500 next year. So we want to max it out. But as another one, it's that 529. If we live in a state that gives us a 529 contribution, we want to make sure we're maxing that out this year, especially if we have kids in the picture, and we want to be slowly funding their education in a way that also benefits us today.
Yeah, definitely. I would second and third both of what you both said there. I think the other thing, urgent tax action to take before year end is to honestly know what your tax situation is going to look like. Get a tax projection done, so you can kind of do that. It's a diagnostic process, right? Let's understand what's going on. And so in order to solve some things, sometimes you need to figure out what's going on with it and how to tweak it. And so all these things very important as we get closer to year end. Got a question about most likely outcomes for TCJA expirations, Section 174, which is R&D tax credit stuff, Corporate Transparency Act, retirement estate planning tips. Yeah, great question. Wish I had a crystal ball. It's a lovely day here in Lancaster, Pennsylvania, but if I could see the future, I'd be on an island somewhere. It'd be a little bit warmer. I wouldn't be on a webinar in the dark. No, I'm kidding. But I think most likely outcome for TCJA is that it gets extended. It gets extended for a set period of years. I think that's the only way that they do it. I think what happens with tariffs impacts that. So if they can do this dynamic scoring process with the Senate parliamentarian and the budget reconciliation, I'm getting real nerdy here, but if they can do that, then there's an ability to extend TCJA longer because they will say we're going to have X amount in tariff revenue, and that tariff revenue can offset the revenue losses tied to extending it. And I think what they're going to try to do is extend it for as long as they can. Section 174, there's a lot of talk about R&D. I think anything we see in terms of research and development and corporate taxes is really going to be around incentivizing domestic manufacturing, domestic development, that sort of thing, right? If you're going to assess tariffs on foreign stuff, then you want to build an incentive for businesses to create jobs here, build things here, manufacture things in the United States. Corporate Transparency Act, we'll see. If you haven't filed your beneficial ownership, your BOI reports for the Corporate Transparency Act, you should do that. There's really stiff penalties for skipping it. We can't do it, but we got our website, brooklynfi.com/BOI, with some tips on where you can go to file it through CorpNet or somewhere else. Retirement estate planning tips. Estate planning lawyers are probably very upset with the outcome of the election. They were going to make so much money next year redrafting all of these plans because everybody thought it was going to expire. Now it sounds like it's going to get extended, or at least stay the same a little bit, maybe even get more favorable. And so the biggest loser of the election is probably estate planning attorneys who bill hourly at really high rates, who had their whole 2025 booked up. Ultimately, with this extension, does make it easier for folks to not lock in a strategy for estate planning long term that they might have otherwise been strongly incentivized to do in 2025. And so for a lot of our clients who tend to be on the younger side and are trying to, are planning to be around for a long time, that's a good thing, because otherwise you're making a trade-off that under the current tax regime will make sense, but under an unforeseen future tax regime 20, 30, 40 years from now may not make sense. And Caitlin, Tiffany, and I have all seen the trust that came through that was drafted in 1995 when the estate tax exemption was a lot lower. And then you're wondering why grandma's $90,000 cabin is tied up in this complicated trust and has a tax return. It's because that's what made sense then, but it definitely wouldn't make sense today. And the best practices to minimize taxes in the new year. Yeah, well, we talked about a lot of accounts here that you can set up and optimize and get in place. I think making sure you have those, making sure you're getting a holistic review of your tax situation to know what that looks like. I think tax planning starts April 16th, if not sooner. As soon as your tax return's done is when we need to start planning for this year's taxes and get a sense of that. And so we had a couple other questions in the chat, the Q&A. I'm not sure we'll get to all of them. Somebody asked about how to stay informed about future tax changes, how it impacts tax strategy. Keep an eye on our blog, on our website. We publish a lot of content on there. We host webinars like this when things are changing. And then our two co-founders, AJ and Shane, co-host a podcast called The Liquidity Event, where they're always kind of riffing about potential policy changes. They did a deep dive on tax stuff last week and the election. And so check that out. It's a great resource. Investment strategies for optimizing my tax situation. Caitlin, you want to touch briefly on just how we think about the intersection of taxes and investing and optimizing that?
Yeah, we're looking at not just what types of investments we have, but where those investments are, the different types of accounts that we have, and the different taxation of each of those accounts, and what investment should be in what account. We want to be taking advantage of long-term gains and qualified dividends, which are both taxed at lower rates. Making sure we're filling up that 15% tax bracket when it's available to us to make sure we're getting the most tax benefit we can.
Got it. And let's see here, another question. We talked about the benefits of retirement accounts. I'm going to, if somebody needs to reach us, you can, I'm going to drop this in the chat, but you can reach out to us at clients@brooklynfi.com. And that's a great way to get in touch with our team. And so I did have a question about that, and that's a great way to get in touch if you want to connect. It is that time though. It's time for us to pick a winner of the Amazon gift card. And so I'm going to go to a random place on the list of attendees, and I'm going to ask Tiffany to pick a number for me, Tiffany. Pick a number for me, and I'm going to scroll to that person on my screen here.
Let's go with 31.
31. All right, that comes up to Danica. So congratulations to Danica. We'll be in touch with you and your Amazon gift card. Appreciate you attending and appreciate everybody attending our webinar here today. We're going to post a recording of this on our website, brooklynfi.com/events. And so if you missed it, if you want to come back, want to understand something we said about it, feel free to pop on our website, brooklynfi.com/events. Stay tuned for more webinars from our team as time goes on, and really appreciate everybody's time here this evening. We'll reach out to the winner, Danica. Congratulations once again, and everybody take care. Have a wonderful night.